Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. It's been a year of resets across emerging markets in light of tariffs and many other geopolitical maneuvers. Some regions snapped back, other regions paused, and several introduced new policy and governance shifts. China, India, Korea, Mexico, and Brazil each portrayed very different narratives. So what drove some of these divergences, and what could they all mean for the year ahead? Joining us here today for his Emerging Markets Playbook is Institutional Portfolio Manager Abhijeet Singh. Welcome, Abhi. Great to see you again. How are you?
Very good. Good to be here.
Great to have you join us here today, and we'll invite everyone to send their questions in over the next half hour or so. I feel like the burning question here is you look at how well EM has done. It's part of an international story that's done incredibly well. Does it still have legs?
That's a great question. I wish I had the answer for you, but I think given what's been going on, what's driving the market year to date, the things are in place for it to continue to do well.
Okay.
We've had the dollar weaken early part of the year, and it's remained range bound. Fed is likely going to cut at some point, maybe this month or next month, and the drivers remain in place that could drive the next leg of outperformance for emerging markets relative to the US, where the valuation story also remains kind of in place. US is still very expensive relative to emerging markets. There are some things, as you mentioned, certain countries have overshot a little bit, others maybe not so much. And our fund is positioned to take advantage of that going forward.
Just remind us of the style that you and Sam deploy. It's GARP, so you're not necessarily going in and buying high flyers in EM markets. You're there studying at the beginning, but just kind of remind us of your style, ultimately what you're looking for when you're looking at companies all over the world.
Yes, so it is growth at a reasonable price, and we value both those things. We look at the growth profile of a company, what's in the price, and then also try to see what are we paying for it. And so our positioning changes over time as things become a little bit more expensive. The story may be intact for a longer period of time, but things can be expensive in the near term. So great example would be companies in India. About a year and a half, 2 years ago, we felt that they became very expensive from a valuation perspective. So taking our bets down there and becoming actually underweight India was the right thing to do within the context of our process. And same true for China. After years of underperformance, we felt that coming into the year that things could be different this year given the valuation differences and also things improving a little bit from an export orientation perspective, and that's why we were overweight. But it's really bottom up in the end. The idea is to think about each company, looking at it very closely, and just making sure that we don't overpay. We remain in parts of the markets that have not necessarily been the darling, like the AI adjacent names, and try to look for opportunities going forward that could generate outperformance.
Let's go through a little bit of the year, maybe even the end of last year to an extent. I mean, China had a bit of an explosion in stock markets towards basically this time last year, essentially. So 2024. I remember you saying that you were there, you caught that, and it then changed some of your positioning around China. I wonder if we can kind of go through the year and fold in some of the examples of countries and companies that worked and didn't work. So in light of China doing so well last sort of fall, essentially, then what in terms of positioning for you?
Yeah. So that original uptick basically petered off a little bit. Coming into the next year or this year, we heard about DeepSeek as all the announcements around DeepSeek coming out of China, which surprised the market, had a sell-off in the US, and created a jumpstart in demand for AI-related activity in China. So every company in their earnings call started talking about AI. They've been very quiet for almost 2 years because of access to chips, etc. And now they were finally again in the game. So we did some trades around becoming more exposed to AI applications. So, companies like Tencent and others can really take advantage of this if they can get these models going and become more efficient and more productive in their individual businesses. Same true for Alibaba, which is the sole or the primary provider of cloud computing in China. That created potential demand for them. And the government has been focused on enabling exports orientation of companies. So companies that can benefit from their global positioning in certain markets, whether it's in EVs or battery makers, that's where the strength of the Chinese market has been. It's been less so about the consumption story, which we have taken some bets off, but kind of a little bit more neutral in that regard, because the domestic data has not really kept up. The real estate remains a challenge there. The consumer is still sitting on piles of cash. So
Can
the
I
story has
just
been more
ask
around
you,
exports.
sorry, within that, there's been quite a lot of expectation from various experts and that China
Yeah.
would stimulate in sort of a very direct to consumer way to get that moving, and we haven't really seen that.
Yeah.
Is there a reason for that?
I would say like we haven't. You're right. We have seen bits and pieces, but then they kind of peter off and kind of disappear. They have like small blip impact, but then they're gone. I think the primary driver or reason for that has been that the exports have been carrying the market, carrying the GDP, and they have been able to export. As I said, EVs coming from BYD, they're selling like hotcakes in markets where they're allowed to sell, whether it's in LATAM, in Middle East, some in Europe, Southeast Asia. And the beauty of that is that they make higher margins on stuff that they sell outside the domestic market. So this is a big tailwind for these companies that can, become leaders in that space. So the government hasn't had to do a lot of stimulus. I suspect if that engine of growth slows down, you will see more sustained and direct stimulus focused on domestic consumption, but they haven't had to do that. And I think that's probably what is keeping them on the sidelines.
So, I mean, in the sense that China got a bit clobbered by the tariff story in April, have they done more stimulus sort of for the export story rather than the domestic consumer? Has
Correct.
that been the change?
That's a fair way to say that. Yes. Yeah. The export orientation has remained through the process. I mean, US is still a big market for their exports, but it's not alone. It's not the primary market. And so they're expanding in other parts of the world where they can.
Right. Really interesting. China moving across the world. To what extent are you underweight, overweight? You said you took a little bit off there.
Yeah, so we're still overweight, but like marginally overweight because the market has done really well. And I think like the next leg is it's going to be wait and see to see like how things go and progress there.
Okay.
Uh, where we have actually remained positive and added to is Mexico, which is kind of a little bit counterintuitive, but it is a it is a market that has a lot of bad news priced in when it comes to trade, as reflected in the currency. The USMCA likely being negotiated next year, so there's going to be a lot of volatility along the way. But a lot of bad news is priced in, so we feel pretty good that you will see that as a place of surprise next year to the market. So having exposure there to the companies that we have is the call to make. And on the flip side, we have taken down or gone underweight a little bit Brazil, where we were overweight early this year and benefited from that when the market did really well. But now the political season is up and running in Brazil. There's going to be an election next year. So any type of uncertainty that comes from there becomes a little bit hard to navigate. So it makes sense to be a little bit on the sideline.
Their interest rates are very high there, aren't they?
Yes.
Where else in LATAM? LATAM is in focus for lots of different reasons right now, and they trade to the world, certainly various countries and companies there. Are there other, are you going you always go company specific, but is there sort of a
Correct.
country story there for you as well? I mean, Argentina, it appears, is getting great benefits from US trade policies and money
Yeah.
injections.
Well, Argentina is not part of the emerging market index, so it's
Right.
kind of a little bit
Okay.
out there. I
Yeah.
think obviously the
It's
dynamics in the
frontier.
economy there are changing. So if they kind of become part of the universe of the emerging market index, then we'll obviously look at it more closely. And same is true for our fund when it comes to Vietnam, which is a market that's done well, has been very interesting because it tends to benefit from any type of diversification that companies do on supply chain side from China to other countries, but it's still not in the in the universe of countries that we look at. But yeah, it's on our radar, and I think some of our analysts have started looking at some of the companies there. So in anticipation of potential opportunity to invest there in the future.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of FidelityConnects podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
Some countries will move out of the EM universe because they're moving up into the developed market area. I know that Korea is working on some reforms. It's a place that you have invested in for some time, but the reforms they're working on, in theory, lead to a more mature equity market system.
Right.
Tell us a little bit about that, or update us on that, where they're headed.
Yeah, I think it's interesting. We rely on benchmark providers really to kind of align countries with various groups of countries. Korea is one of those countries that is actually bifurcated right now. So one index provider, FTSE, thinks of it as a developed market already, and MSCI still categorizes it as an emerging market. And they have been going through a slate of 10 different issues that MSCI had raised a few years ago and tried to address them on a one-on-one basis.
Okay.
But they have had some setbacks along the way, like the political uncertainty towards the end of last year. But they are working through it. So at some point, it does kind of move from one index to another, but usually those things take like multiple years, so we're not too concerned about it. Where the interesting stuff that's happening there is around the value up trade, where a lot of industrial names and more old economy names have done really well in Korea year to date, and some on merit and others on hope. But they are trying to replicate Japan's playbook, where the companies become more, shareholder friendly and less so driven by like a conglomerate kind of behavior. So markets are rewarding it. I think it's still early days. We are monitoring that. But we, as you said, we do have exposure to Korea, but it's not necessarily in some of these high flyers that have done really well here today.
And sometimes the companies I mean, do you look into small and mid cap within emerging markets? Tell us a little bit about the size of the company, how big it needs to be for you to take notice.
Yeah, not necessarily. We do look at like the liquidity profile of the companies that we invest in. So we want them to trade like 20 million daily trading volume. So that we want them to be like sufficiently liquid for us to get in and get out as needed. So the smaller side doesn't necessarily. It's not part of the index that we use, MSCI Emerging Markets Index, and it's not part of the thought process, at least for this particular portfolio.
You mentioned a bit AI at the beginning, how it's working its way through some opportunities in China. Let's fold it into sort of a broader discussion here. I mean, certainly in EM, TSMC has been sort of the story, if you want, for sort of the chips AI story. And it's a very well-known company. I think it's one over the course of the years you've been invested in. And I think it's a big part of the benchmark still. Are these the types of companies that you're still interested in?
Well, that's interesting. I think like this is where we deviate a little bit from like the consensus. So beginning or middle of last year, we have been underweight TSMC a little bit. TSMC went from like a 5 or 6% of the benchmark to today around 12% of the benchmark. So it's a huge dominating position in the benchmark. So we tend to be, within constraints of our parameters of plus minus 5% versus the benchmark. We are a little bit underweight today. Mostly because Sam feels that the next leg up is going to be more around application of AI rather than building, the next data center or the next, the infrastructure investing that the governments and companies have been really excited about and pouring a lot of money into around the world. It's the question of like who can use this infrastructure spend to the benefit of their company and their customers. And that's where I think Sam feels that there is an opportunity to find those companies that are going to create applications rather than at this point trying to still stay exposed to the infrastructure names. So that leads to a little bit of an underweight in information technology sector and also leads to an underweight in Taiwan, which is again that's where TSMC is listed.
That's where its base is, although it's building out in other places, particularly in the U.S.
Right.
Tell us about the Middle East. At one point, the Middle East was a place that I think it was a place you weren't finding opportunities for a number of years.
Yeah.
I think that's changed somewhat recently. I mean, we've been hearing a ton of deals being done, of course, in the Middle East between the Trump administration and sort of for the U.S. more broadly. In terms of investable companies, do you like their energy producers? Do you take a look at they have some interesting finance companies? What's of interest in the Middle East that you'd like to invest in?
Sure. I think the story goes a little bit longer. So once the war in Ukraine started, Russia was pushed out of the index. So obviously we can't buy that. But all that money, energy exposure that people needed, they went to the Middle East. So the stocks became very expensive, and that was why for a number of years we couldn't find anything that would be reasonably valued. That has changed this year. We've seen Saudi market kind of underperform. We built a position in one name in UAE last year, a small position, and today we have a couple of names in Saudi Arabia in the portfolio. One bank, as you said, a private bank, and then the energy producer there as well on the commodity side. Small positions nonetheless, still underweight the country, but again, net better on a relative basis compared to where we've been for the last few years. One other area where we've increased or added some exposure is Turkey. This was also one of those no-go countries from an investment perspective for a number of years. We've seen some changes happening there that encourage us, whether it comes to central bank policy, the government policy. And I think at the same time, it's positioned really well to benefit potentially from any type of rebuild effort happening in Middle East or in Eastern Europe. So they have a lot of capacity, excess capacity for things that'll be needed post-war. When that happens, they'll have a tailwind, but regardless, these are good opportunities to diversify the portfolio.
It's always been a land bridge between Europe and the Middle East, but it seems to be being discussed as much more of an economic bridge as well, with relationships formed there. That's an interesting spot. And as you say, the central bank has cooled out a bit. Yeah.
Yeah.
With energy, is energy of interest to you as a broad statement, or is it just a very particular opportunity?
Energy sector is a very small sleeve of the benchmark, so it's not going to drive a lot. So we did have Petrobras for a number of years, but as I mentioned earlier, Brazil is becoming a little bit more tricky from a policy standpoint and where things might go over the next 12 months. So we sold out of that and then bought like a replacement in the Middle East. Overall, we are underweight the energy sector because one large part of that is Reliance Industries in India, which is a conglomerate. And that's a little bit hard to kind of justify that as a position in the energy sector, but it is nonetheless in that benchmark. So that'll be an interesting storyline. I'm sure we'll talk about it sometime next year as Reliance kind of looks to spin off their telecom business sometime next year. They've started making some moves there, so that could make this the remaining part of the company becoming a little bit more energy than being a conglomerate.
I mean, the remaining part of the company is still a gazillion different companies. It's cement, it's energy, it's still, but
retail,
that's,
lots of stuff, yeah.
Very interesting, and one of the stocks that just went to the moon, didn't it? It came back. So just talk a little bit more about India, sort of in its stock market, meaning ups and downs. I mean, do you expect it to sort of catch an upswing?
So our thinking there has been obviously from a bottom-up basis, and that's led us to being underweight. So at one point, which was I think early this year, we were our max underweight, which is close to 10% underweight, which is allowed within our parameters. And today we are much less than that. The reason for that is it has underperformed a lot compared to the rest of the emerging market index and countries. So the valuation has started coming down on a relative basis. So it's becoming a little bit more attractive from that standpoint. There's still some room there. So we've added to some infrastructure names that we had in the portfolio already, a private bank, to reduce that underweight. I know Sam's planning to go on a trip to India early next year, I think February, beginning of Feb. And so when he goes and attends a conference and talks to companies, might come back with some more potential ideas for the portfolio that could help us reduce the underweight there. But it is, even after the underperformance, it's still quite expensive. So you got to be cautious there. So the trade between, India and China might continue for a little while, or India and rest of EM.
Why is it so? I think you've said, these are your words. I remember you saying it's a vibrant economy. I mean, that's part of the reason that it's so expensive. There's a lot of hope built in there, it sounds like.
That's correct. So it's always going to have a premium by the nature of the growth level and the middle class and the earnings potential that's going up for like the people coming to the workforce. There's a huge amount of infrastructure requirements. So all those things are great. So the long-term drivers remain. It's just that, like, what do you want to pay for it?
Yeah.
So some portfolio managers might be okay with paying that excessive multiple. Us, we don't. So that's what's reflecting the positioning today.
A couple of questions coming in, Abby. One of them you touched on, but let's just go back to talking about investing in China and a discussion of the risks of investing in China. I mean, there have always been risks in terms of transparency. That's nothing new, and you have a way of handling that. Are there layered on risks on a geopolitical basis as well? Maybe talk about a couple of different risks that you face when investing in China.
Yeah. So one thing that we have, which we have talked about in the past, are our governance and forensic accounting research that helps us navigate, opacity, or like not being able to kind of see more behind what the companies are doing. So having that team, two people actually in Hong Kong that are focused primarily on China helps. So that's one side of the equation at a company level to be able to do that before we invest in a company. The other thing is geopolitics is very tricky because it's having an impact everywhere. So I think if we if you go back to April of this year, we would have probably all sold everything and put everything in our mattress. But obviously the markets react to news, they adjust to news, they digest the news, and then they move forward. So we've seen that happen a number of times throughout my career, and this is no different. So I would say, like, again, focusing on the individual companies makes the big difference. The policy, the geopolitical part is kind of additional input, but should not be like the primary driver of like what companies you buy and not buy.
I mean, the primary driver of most EM investing is India and China. You've mentioned throughout this discussion that that you've sort of brought down exposure to both of those for kind of pretty different reasons. But has that allowed you to go elsewhere? I know we've touched on some of them. Are there other places that suddenly you've got room to take a look at other places and companies?
Yeah, that's a great point. So we have expanded a little bit more exposure to ASEAN, which has not been something that we've been invested in. So we bought a position in Indonesia recently. The stock's not done very well. The markets had some macro headwinds. So this is a very good, one of the best run banks, and it's coming at a very steep discount to its history and to the rest of the banking sector with an EM. So that's one name. I mentioned Turkey. We continue to keep exposure to Greece, to Hungary, to South Africa. Those have been there already, so we've adjusted positions a little bit there, but those are still intact. But from a new area perspective, Saudi Arabia, which I already mentioned, and Indonesia is the other one that was not there before.
Just a quick note for those before we close. But first of all, the debt markets for EM have been interesting, and this is not necessarily what we're talking about, but it underpins a lot of investing, of course, how the access to debt is going. Many of the EM countries are not as badly indebted, basically, as developed,
Correct.
so-called developed nations. What does that lack of debt overhang mean for their economies, for you?
I think the main thing is that like the interest rate policy can be a lot more dynamic. That's why the focus tends to be on the US dollar, because again a lot of the international trade, global trade happens in USD. So that becomes the more of a component of understanding what the central bank is thinking about. Like the central bank in the US has to think about debt servicing cost, when they're thinking about like what the interest rate levels should be. The fiscal policy should be thinking about it as well. In other parts of the world, it's more about inflation. In emerging markets, more about like the currency. Can we keep the currency stable? That helps with imports, especially for countries that import more than they export. India does a lot of that
energy.
because of the energy imports. But that's the emphasis tends to be on other drivers rather than the debt level.
So we've mentioned a couple of times, Abhi, in this conversation, benchmarks and how much some have of certain stocks and so on. How are you guys doing against your benchmark?
It's been a great year. I think hopefully the investors can see that at the website or the reports on the fund. It's been a very good year. Our positioning coming into the year really worked out, and we've added good amount of value. I think the benchmark is up a lot as a asset class.
It's over
and we've added value on top of
30%
that.
year to date, and you're on top of you're higher than that.
We are on top of that, like 3 to 4% on top of that. Yeah.
Wow, congrats. It's fantastic to have you help us close out the week. Anything you'd like to just quickly share with investors as we tip into another year of investing?
I think like this is a year to kind of show you that diversification works. It does work. Everybody should not be in the same bucket of like mega cap companies in the US at all times. And it's really proven that having that exposure outside North America is the right thing to do. You can't time it, so that's why it should be more strategic in nature in terms of allocation. And these types of years make me look smart.
Maybe all years make you look smart. I don't know. Great to see you, Abhijeet Singh. Thank you for joining us.
Thank you. Bye.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.